Now we got to talk Federal Reserve because, boy, we've got a lot of different reports coming out from the Fed and one from The Economist that's really phenomenal. We'll be going through in this video here, and we'll also be talking about how you don't want to experience JOMO or FOMO. Yes, there is now literally a JOMO, and we'll break that down all in this segment. So first, let's start with a few charts that initially might make us a little nervous, but then we'll balance that off with maybe a little bit of peace of mind. Who knows? We'll see. Let's balance out what's going on in the market because there's a lot of noise. So here's the first chart we've got to pay attention to. I'll actually keep myself removed so that way you can see all of it. This first chart is the 5-year break-even chart. Now, we've been studying this all year long, so you should already, if you're a regular viewer of the channel, should already be pretty familiar with this, and hopefully familiar with this, nice downtrend that we were having on the 5-year break-even. It's not perfect, but we had a pretty decent downtrend here on the 5-year break-even. Unfortunately, that has somewhat gotten destroyed a little bit over the last month, and that's because we've gotten data out from January, like hot jobs data, hot PPI data, hot CPI data. And so our trend that we're really paying attention to looks a little bit more ceilinged like this, but it's difficult to call it a trend because, well, you're kind of just re-accelerating on the 5-year break-even curve. Now, what is this curve and why is it so important? Well, the 5-year break-even, as a quick recap, is essentially your bond market's expectation of inflation. And anytime we get this sort of resurgence in the 5 years, especially if we start breaking trends, or now we're making it harder to actually create trends, it's a sign the market is more uncertain about what the future actually holds, and the market is pricing in higher rates of inflation, usually coinciding with that, you're getting a higher terminal rate from the Federal Reserve. Now, in the long, grand sort of scheme of this chart over the last year, the chart is straight down, which is phenomenal. It's essentially straight down. However, even that essential straight down chart, trend line has somewhat broken a little bit, right? You're starting to see maybe that move up. And if you were to trend it like this, that's not too much of a trend. That's a 2-point trend. Maybe you call a third point over here. Point being, you've got nervousness about a resurgence of inflation. And that resurgence in concerns over inflation suggests we're, first of all, a lot further away from the 2018 Federal Reserve, sort of U-turn at the end of 2018, where the Federal Reserve decided, you know what, we're not going to continue raising rates, and all of a sudden the market had its greatest rally throughout the first 6 months of 2019 after the pain of the end of 2018. But inflation expectations there were sitting around 1.6%. Right now, they're sitting somewhere around 2.5%. We're almost a whole percentage point now away. We were starting to trend to breaking 2, but then we shot right back up thanks to the January data, which is not great. Now, to offset that, fortunately, financial conditions have immediately tightened actually quite a bit, which helps the Federal Reserve relax on this idea that they need to be so excessively aggressive. Here is a chart of the Financial Conditions Index as put together by Goldman Sachs. And you can see financial conditions in the month of February have tightened quite a bit. And specifically why they've tightened, well, it's this trifecta of pretty rough reports that we've gotten from, again, either jobs or CPI or PPI. On top of this, real rates in the United States compared to the rest of the world are now probably at some of the highest levels that we've seen this certainly that we've seen in this tightening cycle, but they're also relative to other countries that are relatively modern economies like ours. We're seeing some of the tightest conditions on real rates. Take a look at this particular chart here. It shows you that real policy rates in major global economies are positive in the United States and Canada, with the United States at real rates at positive 0.95%, Canada at 0.7%, and New Zealand, Switzerland, Norway, Australia, Japan, the United Kingdom, the Eurozone in aggregate, and Sweden still actually negative with real rates. Now, the way they calculate real rates is you're basically taking rates where they are and then subtracting inflation from that, annualized inflation generally. So this is where you're getting where real policy rates sit. And the United States is finally in an era of positive real rates, which that's what you generally want to try to crimp the economy. To stick a soft landing, you have to take the heat out of the economy, and you generally do that once real rates become positive. The Federal Reserve has never paused their hiking cycle until these rates have gone positive, and the good news is they are positive now. And in combination, or should I say maybe in conjunction with real rates actually going positive and Jerome Powell suggesting, hey, maybe we can just continue to sort of look through the January data, we've actually seen some pretty substantial surges in particular sectors of the stock market at the beginning of 2023. You can see consumer discretionary, communication services, IT, tech, right? These are some of your biggest gainers at the beginning of 2023 relative to what were the gainers like utilities, energy, and staples, and those becoming losers at the beginning of 2023, despite them having been the gainers in 2022. Now, obviously, we know that the break-even rates are moving up on the 5-year. That's not great, but at least it's being offset by tighter financial conditions and real rates. And really what it does is it says, look, we just have more work to do. Well, that's obvious at this point. But with some of the hot reports that we've gotten, there is this concern that the Federal Reserve is potentially going to come out with some form of 50 BP hike or some kind of rug pull, basically. And I'd like to point to Mr. Barkin from the Federal Reserve, who was quoted over here in a Nick T article that circulated pretty much right after Loretta Mester and right after Mr. Bullard suggested, we were actually for 50 basis point hikes. Pretty much right after that, Nick T ends up sharing this article of the Wall Street Journal, an article that he wrote on Barkin's stance on it. Now, one of the reasons this is so important is because Nick T is generally deemed to be sort of the mouthpiece of the Federal Reserve, kind of where we don't know this, but we can sort of suspect that Jerome Powell probably texts Nick T and says, hey, you know what, can you massage the messaging like this today? It kind of feeds into the idea that the media is sort of just the mouthpiece of the government anyway. But anyway, so we don't want to go tinfoil hat here. So anyway, let's keep going. So what do we have in this piece over here? Let me fix this darn cable over here. What we have is basically Barkin suggesting that he's a big fan of continuing with 25 basis point hikes and getting rates above to really that 5% range. We know we unanimously moved to about 4.5%. But what is interesting that Nikki T shared this piece where Barkin suggests he likes the 25 basis point path because it gives us the flexibility to respond to the economy. Basically, it lets you just say, hey, we'll just keep hiking for longer, but we're not going to go with more aggressive sort of 50 basis point hikes. I think that's basically priced in. I think we had some fear mongering of this 50 BP hikes. I personally don't see that happening. I think this Nick T article reconfirms that, especially as potentially a mouthpiece of the Fed. And Barkin suggested that regarding the January reports, and this is actually really powerful, also not just reiterating 25 BP hikes, but also because, hey, what's the Fed saying about these January reports? Well, what's fascinating is this section right here, where Mr. Barkin said, economic figures over the last 2 weeks have shown surprising resilience in spending and hiring. But, and here's the big one, this is a big but he added he wasn't ready to substantially revise his outlook because the potential for unusual seasonal volatility, including a longer holiday spending season in the fourth quarter, warmer weather, and changes in how employers are managing the size of their workforce given recent difficulties in hiring. Now, this is really interesting. I mean, think about this for a moment. This winter has been bizarre. We had a colder December, but we had a warmer January. You almost had, as many are saying, a spring-like January. And what's interesting about that is in the last CPI report, for example, we saw this big boom all of a sudden in apparel spending. Apparel has been one of those goods sectors that has been plummeting from an inflation point of view. Why all of a sudden is it up? Essentially 9.2%-ish on an annualized basis. Or sorry, I think it was 9.6 because it was 0.8 month over month. That annualizes out to 9.6% annualized inflation. That's insane. Why would apparel be moving so hot? Well, some are arguing it's because since January was hotter, you ended up having people buy, potentially, spring clothing in January. Now, what's interesting about buying spring clothing in January? You might think, come on, like, who cares? Like, if you buy it in March versus January, what's the difference? Well, the difference is the same thing that happens with winter clothing at the end of the winter season is the opposite of what happens with spring clothing in winter. Let me explain that for a moment. And I think the easiest way to do that is graphically, because I think that might have sounded a little confusing. But if, let's say, your winter selling season is October to January, your merchandise for the winter season is going to be most expensive in October. It's probably going to be most full price in October, and it's probably going to be at the lowest cost in January, February, or it's most discounted. That's because at the beginning of the season, people go buy their winter clothes. And at the end of the season, they don't really need any more winter clothing, so the apparel companies discount the winter clothing. But when would spring clothing generally be the most expensive? Well, probably around January, because it's the beginning of the spring era. It's the beginning of the spring shopping era. So there is this potential idea that a warmer January could have actually led to a spike in apparel costs, and that really maybe what Mr. Barkin here was saying is, hey, look, this was a weird winter. It's also a unique era coming off of massive seasonal adjustments where not only are we no longer using 2 years of data because of the pandemic for weightings, we're only using 2021, which is the first time we've only done 1 year in recent history. And now we have a substantially higher weighting to certain categories, especially like housing, which we already know are running hot, and the transitory sort of, or maybe I shouldn't say the transitory, but the disinflation hasn't actually started occurring in those sectors. So you do have this potentially bullish look-through argument that's happening at the Federal Reserve. Now that puts quite a bit of weight on the next CPI reports, right? Obviously, on March 22nd, you're going to have the next Federal Open Market Committee meeting and then you'll have the J-POW press conference. But obviously, the next CPI and the next jobs report are probably going to be more critical than what we actually had in January. Now, that's wild. But because of the seasonal adjustments, you're actually putting more weight on these next reports. The next CPI report, by the way, is March 14th. Because if we end up seeing something like a spike in January and then a correction sort of back to trend in February, then maybe the Federal Reserve would be inclined to actually look through the hot data of January that we got. If we ended up getting 2 strong reports in a row, we could end up seeing that March FOMC meeting and the summary of economic projections revised up. In other words, the terminal Fed funds rate. What if we start seeing something like a 5.75 or even a 6 handle? What if the Fed thinks GDP is going to be higher for longer and therefore they might have to hike more? Right? These are all things to obviously consider. Now, The Economist gives us a little bit of color into how successful the Federal Reserve has been when it comes to landing a soft landing. They actually suggest that a soft landing originally came from this idea of the Apollo 11 mission, where the goal was basically to take some heat off the engine, so to speak, and softly land the lunar lander without crashing it, right? Unfortunately, the last major time we tried to do this in the 70s, Paul Volcker ended up pushing us into, as they say here, major and successive recessions, as well as the worst joblessness since World War II. And so when we look at, hey, are we going to have a soft landing or not, it's somewhat worth looking at, well, how successful has the Fed been? And The Economist gives us some insight into that. They say, if history is any guide, fears of missing the soft landing are likely to return. It's not that soft landings are impossible. Since the 1970s, Fed policymakers have managed them twice. We had soft landings in 1984 and 1995. America's stock market began to rally just as interest rates reached their peak, and investors who bought early were rewarded with sustained multi-year bull markets. Obviously, if you're heavily invested in stocks right now, you're hoping for a soft landing, which a soft landing could be no recession, or it could be a very, very, very minor recession without a meaningful increase in unemployment. And that could happen if it's sustained by inflation essentially plummeting, sticky inflation becoming unsticky and going away, and hopefully, a company earnings cycle over the next year and a half here that doesn't end up substantially below estimates that end up leading to some sort of earnings per share crash in markets. But anyway, there have been 6 other tightening cycles in the last 50 years, and all of the other 6, unfortunately, were followed by a recession. And the lesson from the economist here is that if out of 8 times you were only able to land a soft landing twice, you have about a 25% chance of sticking a soft landing just based on history's guide. That means you have a 75% reason of believing that a soft landing is just a myth that perpetuates a sort of bear market rally. Now, a lot of January's bear market rally was really driven by, one, retail plowing over $1 billion a day into the stock market in January, and number 2, short covering. Institutions caught off sides thinking shorts would continue to protect them in 2023, only to get squeezed. The squeeze has been squoze. Now, we'll have to see how markets react to this data, and we are going to end up getting a trend. But what else does the economist tell us? Well, for soft landings, generally, once the Federal Reserve began to cut rates in soft landings, the bad news ended. Once the Fed cut rates in soft landings, bull markets ensued and you had multi-years of positive returns. Whereas in hard landings, you actually still had the worst parts essentially to come. Weaker employment, weaker housing, weaker earnings per share at companies. Now, one of the things to consider, because it always comes up, even though I've made a plethora of videos about the darn Fed Reserve pivot, it's important to remember that when the Federal Reserve ends up pivoting in this cycle, they are doing so because they realize they have achieved, or at least they believe they have achieved, fighting inflation, right? This cycle, the Fed only pivots when inflation is convincingly falling or gone towards 2%, right? So when you get a Fed pivot in this cycle, you're actually expecting probably the most bullishness from markets, even though some folks like to point to charts that are very misleading, suggesting that, if the Fed pivots and reduces rates, the worst is yet to come. That would really imply that the Federal Reserve pivoting on inflation is not why the markets are rotating down. Markets are generally pretty concerned about the Federal Reserve and its fight against inflation. Though we could also see the markets manifest fear thanks to an earnings crush, right? We could end up having a Fed pivot and inflation ends up being gone, but how bad did things get from the Fed's lagging policy rate increases? And that's where the question is the stock market pricing in an EPS crush, or is this stock market more concerned with the odds of inflation staying around sticky and for longer and essentially inviting a new Volcker era? My personal belief, obviously, we've said this pretty regularly on the channel, is that we're likely over 2023 to have a lot of noisy data, ups and downs and volatility, but I am a big believer in the Nike swoosh recovery, where we probably, although it's obviously not certain, have probably recognized some form of bottom behind us. And this Nike swoosh recovery is probably going to look quite volatile on the up and down, but it really reiterates the idea of essentially buy the dip in 2023, which was not the 2022 strategy. 2022 strategy, where if you really wanted alpha in 2022, short. Shorting was the way to get alpha in 2022. That's probably a lot more risky in 2023, but we'll see. The Economist takes a little bit of a bearish point of view, though, and that's in contrast to my point of view. They suggest that the stock market is really a bad guide for suggesting if you're going to be in a situation where the stock market has bottomed and will continue to go. In fact, what's more of a guide, in their opinion, is the history of previous Fed tightening cycles and how soft landings that have occurred were generally preceded by relatively low inflation, accompanied by looser bank lending. Well, unfortunately, today, we have exactly the opposite. We have high inflation and actually tightening lending standards. And the fear is that those are going to lead to job losses and crushes in earnings. Of course, this is where I respond and look at, well, leading data, whether that's in hiring or the supply of labor, actually suggests that we shouldn't be seeing a labor-induced inflationary regime continuing any more than maybe the first few months of this year, as we've talked about many times before on the channel, whether that's the excess supply we have of drivers for Uber, Lyft, the excess availability of people in tech at Starbucks, at Chipotle. Look at Cloudflare's earnings call. Look at what Procter & Gamble and Tyson and Johnson are saying. All of them are saying, look, there's some embers of inflation, but we're at a limit in terms of how much more we could really raise in prices. Maybe we're on our last cycle of price increases, and that's it. Then our margin is getting squeezed if costs continue to go up. However, we're starting to see that light at the end of the tunnel that the second half might start looking more disinflationary, or at least you'll see a pause of inflation. So that's an idea. You've got insights on both sides saying, look, inflation could continue to drive us into an earnings recession, especially if it stays around stickier for longer. But I'm of the mindset that as long as inflation can get conquered, the entire reason we need tighter rates is not structural, it's solely inflation-based, which is the result of us printing as much money as we did during the COVID cycle. So we'll see. Some say, hey, a recession is exactly what we need. We need a recession. We need to force a recession so we can actually make sure we get rid of inflation. Maybe. It's entirely possible that we have to slightly force a recession. And this is where some folks say, you know what? If there is no recession, you could actually end up having a worse outcome. Here's a piece from Stephen Blitz, who suggests that the data we're seeing now is pointing us to a recession. Whether you look at the inversion of yield curves or you look at retail data, January, we had a nice little pop on retail. Could be based on some of the seasonal factors that I've explained earlier. But here's what I found. Oh, there goes Siri. Go away, Siri. There we go. But take a listen to this quote right here. Employment is a lagging indicator until it is coincident with the start of a recession. Nevertheless, activity is slowing. Real policy rates are positive. The curve is inverted, and we are still sticking with the mid-year recession call as a base case. If there is no recession, outcomes will be worse, suggests Stephen Blitz here. And I think the reason he suggests that is because without an actual slight recession, you keep inflation higher for longer. You don't want inflation higher for longer. You want that inflation going away. Fortunately, from at least what I'm seeing in company earnings calls and reports, is that inflation should be continuing to go away, especially once we get that housing data showing a decline in owners' equivalent rents, and then services maybe leveling out thanks to finally less wage pressures. Maybe by the end of 2023, we don't end up having sort of a double dip surge of inflation. We can get rid of inflation. We'll see. But this idea about no recession potentially being bad because it keeps inflation ignited is something to consider, to where maybe that's just what we need. As a healthy part of the cycle, you go through a shallow recession, and that's what it takes. This individual suggests that the economy's slide towards a contraction is looking normal. In other words, it's looking like that is exactly the path we're on. However, by threatening to hike by 50 basis points, financial conditions have become less easy, and ultimately, you could end up seeing more pain in the stock market here in the short term, as well as dragging down discretionary income. So in other words, while all of these indicators that Mr. Blitz is looking at, such as the inverted yield curve, real positive rates, and the lagging effects of a hiked monetary policy, Mr. Blitz thinks, hey, you don't want to get too hawkish here because then you could really push us into more pain. So you've got a lot of these sort of perspectives on where the markets could go. And it's kind of frustrating because sometimes it feels like they're all pointing in different directions, but I think they're actually not. I actually think they're pretty clear. I think it's very clear that yes, the economy is trending towards a recession. Yes, the odds of no recession and that Goldilocks sort of soft landing is only 25%. That is according to The Economist, as we already reviewed. All of that indicating we are trending towards a recession. Yeah, we had retail sales spikes and some data spikes in January, but we think those are mostly seasonal until we get confirmation that they're not, especially a January sort of adjustment cycle. It's too soon to say that, oh, that's it, here's the second wave of inflation, especially with leading indicators suggesting that from companies, hey, it's getting easier to hire, there's more availability of labor, and more availability of labor kind of suggests that eventually the unemployment rate will probably rise, just like the Fed is looking for. That would also suggest trending towards that recession. But all of these down arrows also suggest inflation goes away, right? As long as we're trending towards a recession, we should see inflation go away. And since inflation expectations are anchored, we really hope that we don't end up seeing a second wave of inflation. And this is where the Fed really has to guide us dangerously close to that recessionary line where, yep, maybe we end up having to dip slightly below before we come out. But there's very little, at this point at least, that suggests, hey, look, we're definitely not trending to a recession. I don't think there's anything that says, oh, everything's up. We're definitely not trending to a recession. Yes, you could point to temporary retail sales data, but I think that's more of this floating arrow here, where you're still on a trend towards a recession, but yes, you're maybe slightly above that recession line. I don't think there's anything glaring that's like, we're definitely not going to a recession. Although that would be the most ironic, right, if we end up not having a recession, because this has been such a predicted recession. So I don't think you necessarily have data that suggests, okay, definitely no recession. While at the same time, I also don't think you have data that suggests, oh, we're definitely in hell over here in terms of the data's so terrible. Our consumers still have substantially more savings. And sure, while the excess savings rate has declined, and a lot of people are, in my opinion, using that as, dare I say, clickbait. It's the excess savings rate. You can Google the excess savings rate, but I'll go ahead and pull up the chart for it. And the personal savings rate has fallen substantially, even below prior levels of before the pandemic. You can see that on the chart here. Actually, let me remove myself so you can see that a little bit better. We're at one of the lowest personal savings rates that we've seen really since about the 2005 era, where the personal savings rate fell to around levels where it is now. But look at pre-pandemic, you have the personal savings rate substantially higher than where we sit today. And historically, the personal savings rate has been a lot higher. So certainly people are not saving like they used to. And if we zoom in to just maybe the last 10 years here, you can see we're certainly at the lowest levels of a personal savings rate. And that is starting to slightly tick up. You saw it slightly tick up in December. However, it's very, very low. The way to offset this idea, though, that this is definitely bad news, that this is definitely this giant arrow to the downside, is by remembering, and I've mentioned this a few times over the past few days, so forgive me for sounding redundant, I just think it's so important, remembering that the average checking account of somebody who had $2,500 to $5,000 in the era before the pandemic, so like 2019, now sits at an average of $12.8 thousand of excess savings. That's different from that personal savings rate. Yeah, the personal savings rate might be low, but if you're sitting at 2.5 to 4 times as many savings, maybe you don't actually need to continue saving that much, and you're still able to spend in markets and in the economy. So, point out of all of this entire segment is, yeah, you got to join me on those programs on building your wealth down below, obviously. But really, the big bottom line out of all of this is when I try to reconcile all of the noise, I'm not seeing things that are so terribly bad that I believe I need to be completely out of the market. I did feel that in January of 2022. I do not feel that here in February of 2023. I also don't feel like things are so glorious in the economy that we're definitely going to avoid a recession and that we're definitely going to the moon. So that to me says I don't want to be all cash and I don't want to be heavily in margin. And that's where I think the easiest way to sort of reconcile all of these perspectives is probably, and of course you've got to personally come up with your own allocations. I can't do it for you, but I think it makes sense to be exposed to equities and certainly, a bond portfolio, maybe a 60-40 invested portfolio to the tune of maybe 80%, 80, 85%, 90%, maybe keep that 10, 15% around to psychologically help with some of the volatility that we're going to get. But that's been my thesis for about the last 3 months, and it's been pretty consistent. And so hopefully that helps guide a little bit how all of this noisy data doesn't necessarily all have to point to deep dark recession or moon. It actually could just point towards, okay, yeah, this is the process of a Fed-managed disinflation process. Could end up going to crap. Fed could end up breaking something, but I would call that a tail event. Let me actually draw that graphically. So a tail event is really when you look at the bell curve of probability outcomes. So you look at a bell curve. This is not necessarily the best bell curve over here, but you end up with tails, right? So you have a left tail and you have a right tail. These are sort of your lower probability events outside maybe the 5% range. So if you look at, 2 standard deviations off of the midpoint, you're probably, if I'm drawing a bell curve correctly over here, you're probably at over here looking at maybe roughly 2.5% probability, and over here 2.5% probability. Maybe it's a little greater, but I think everything going to hell, in my opinion, is probably over here on that 2.5% chance, and everything just straight going to the moon without any kind of volatility. Larry Kudlow V-shaped recover, probably in the order of a 2.5% chance as well. Whereas I think there's much greater of this. Yes, look, volatile Nike swoosh, and that's at least where I'm placing my bets. Could be wrong, but it's where I'm placing my bets. And I always like to say that because I put my money where my mouth is, even though I change my mind a lot. I do put my money where my mouth is. Now, and then of course you have this question here, why is the risk-free rate 5%? It's because your opportunity cost of sitting out the market is actually substantially high. If we do end up landing a soft landing, which I think is probably the base case, which could be a shallow recession or a very close recession, you're probably going to sit out on massive equity returns or even bond returns, right? So if you were to invest today, and in a year from now the S&P 500 is up, 15%, but you were all in on a 5% risk-free rate, well, you just missed out on 10%. And so that's pretty important. Oh, that reminds me, we didn't talk about JOMO. We're supposed to talk about JOMO. So let's touch JOMO really quick because I thought it was very fascinating. Is you have this idea about the joy of potentially missing out. And I think this is really like a bear, I hate to say it, who's lost his mind. He literally writes, JOMO, this is the opposite of FOMO, fear of missing out. It's the joy of missing out. And Scott has JOMO on the crazy stock market for now while earning 5% on 6-month T-bills. And basically, this reiterates this question that we just got. Like, hey, look, the risk-free rate on like 6-monthers or whatever is basically sitting at close to 5%. Why? Why would you invest in equities if the average long-term return of equities is, 7% without dividends, maybe 9.1% with dividends reinvested over the last 40 years? Why would you bother investing in equities? And you really wouldn't, right? You really wouldn't. Like the spread between the next 12 months even of earnings per share on the S&P 500 and the 6-month T-bills is only 50 basis points. That is a very, very, very low spread. It basically says, why bother with the risk of the stock market, right? And U.S. money managers are sitting on the sidelines with $6 trillion of money ready to invest. And that actually is leading a lot of people to say, hey, they're just going to sit on the sidelines and milk their 5% or whatever. But there is a very big counter trend to that, which says, well, if we did have a soft landing, you're going to get caught off sides if you're sitting in your 5% T-bills, because you're going to be that person who's today going, ha, 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 I'm making 5% risk-free. Meanwhile, the stock market maybe looks back at you in 2 years and goes, ha, 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 2 years went by and while you made your 5% per year, we made 15% per year. right? That's possible. Of course, with that risk comes the chance also that it's actually equity bulls who end up sitting off sides and they end up getting screwed with another 20% downside again. Nobody really knows, but I'm staking my my pole, so to speak, with the bulls on this one for equities.